And finally, analysts may have a neutral stand on the local real estate investment trust REIT market with a less than rosy outlook for next year. However, YTL's hospitality REIT seems to be the exception with its considerably high 12-month rolling distribution yield of above 8.29%.
The REIT is one of the property trusts of the YTL Group and owns prime hotels in hospitality-related properties in Malaysia, Australia and Japan. In its latest financials, the REIT recorded an income distribution of 112.06 million for the financial year ended June 30th, 2014. This translates to 8.46% per unit on a distribution per unit basis. If one takes last week's closing price of 1 ringgit 3 cents per unit into account, the yield is slightly lower at 8.2%. Comparatively, according to the Edge Research, IGB REIT, which focuses on retail properties, gives a rolling 12-month distribution yield of 5.71%. Similarly, Pavilion REIT gives only 5.09%, while Axis REIT, which invests in industrial logistics properties, gives 5.44%. Helen Tan, Pacific Mutual's head of equity, said that a DPU, or a yield of 8.2%, was a good return. It was higher than retail REITs, which typically offer 5 to 6%, while the yield for office REITs was around 7%. According to the REIT's 2014 annual report, the attractive yield generated by the property trust is attributed to the consolidation of results from its Sydney Harbour, Melbourne and Brisbane Marriott hotels in Australia. The results were driven by better average daily rate, higher occupancy rate and larger revenue per available room.